I was on a modest income of $65,000 coming out of university. When I did the depreciation schedule, I think it was circa $13,000 I got back in the first year as a tax deduction. The low value pooling method is saying that anything that's worth less than $1,000, you could actually aggressively depreciate it. Before you scrap anything, make sure you take photos and you ask a quantity surveyor, can I claim any scrap value out of this property? Get the report done before 30 June, because once you tick over to the 1st of July, that invoice that you pay for the quantity surveying services, you don't claim until the following year. It's a cash flow tool, it's money on the table.
Hi everyone, welcome to another episode of the Investing for Doctors podcast. I'm your host, Dr. B, and today we have Tuan here with us from Deductions. So Deductions is a tax depreciation company that's been around for more than 10 years now. And recently they've also started a valuation business about 4 years ago. So Tuan, welcome to the program.
Thanks, B. Appreciate you having us on.
Yeah, so let's start off with who you are, where you come from, and how did you get into the business of doing depreciation reports?
Yeah, we'd love to. Thanks, B. And for us, for myself, it's been an interesting journey because I was a property investor like most before starting this essentially a property services business in that we provide tax depreciation. Probably about, I think, 2010, I bought my first rental property in the humble suburb of Canley Heights in Sydney, Western Sydney. Yeah. I grew up around that area, about Cabramatta, Liverpool, and spent most of my life there. So you always bought where you're comfortable with. Back in the day, you could do
absolutely.
That.
Yeah.
Those days are now numbered, but you could do that back in the day. And so part of that journey was going to an accountant, getting advice on doing tax returns, claiming all your deductions, declaring your income on your rental. And then, of course, there was advice about tax depreciation. I was like, great. I getting a quantity surveyor on board. Once you appoint a quantity surveyor who essentially measures brickwork and all materials on a construction site to understand what it costs to build a specific unit or house or a duplex or villa, whatever. But end of the day, when you go see this quantity surveyor, they're able to empower you with what is a tax depreciation schedule, which then you take the building costs, it breaks down all the plant and equipment, all the building costs associated with that purchase over a 40-year life, and then you use that to claim a tax deduction. Okay.
So the first time you got your investment property, you obviously had to get that done. What was the process like for you, and what prompted you to start a business in that?
For me, it was, I was on a modest income of, I think, $65,000 coming out of university. And so when I did the depreciation schedule, I think it was circa $13,000 I got back in the first year as a tax deduction. And $13,000 on a 65K income, less HEX and this and that, it was a large chunk. And so when I was getting that $6 or $7 grand back that year, I was like, I can't believe how effective something like this could be. For what I think it was $660 I paid for a report. And I thought, you know what? This is a great thing to do. And it wasn't very complicated. I had a quantity surveyor come around my house, 15 minutes they spent, 20 minutes they spent doing some measuring and working out on, what type of joinery did I have? Was it a brick veneer home? What type of ceiling did I have?
So someone physically went to your place.
Physically inspected. And I realized that for the money spent, it was well worth it. And so being a quantity surveyor and also had a construction background, I thought, well, here's a real opportunity to really help people out there save money through a service that is, it's black and white, value adding.
So you saw that as an opportunity as well, isn't it?
I did. It was very much a case of, a value add. And when you sell something where the value is so intrinsic and obvious,
you feel good.
It makes it very easy to sell. And it's something that I don't really have to work very hard today to convince someone to buy a tax depreciation schedule, because really it's a legislation that was established in 1997. TR, which is taxation ruling 1997/25, enabled people, residential property investors, to claim depreciation on rental properties If they had bought one, then they obviously its use case was that they had created rent or developed rent out of it in exchange for that property, and so they could use it in a tax deductible way, meaning they had to declare the income, but they could also claim losses against that property, such as interest on the
loss
loan.
in value and
Loss in value. Of course, loss in value is being one of them as well. On top of the
So with the property, that came in 1997.
Yep.
Before that, was there just no way to
depreciation
to do that at all?
was not as prudent prior to then. It wasn't until that legislation comes out that we were able to claim depreciation on any residential property, both secondhand and brand new. And it meant that there was an opportunity for people to negative gear their property very aggressively, because a loss in building value, we're talking about hundreds of thousands of dollars, except over a 40-year lifespan.
So previously you could not depreciate it at all, or was the way of depreciation not clearly set out that you could do it anyway?
It was not very clearly set out, but it wasn't really until 97 that it was established that you could claim it.
So you couldn't do that previously.
That's right. Division 40, Division 43, which is the tax ruling that allows you to claim the building and plant equipment with the official tax term, then was established in that you could segregate the two asset classes, and then you would assess plant equipment being things that are motorized or would generally fall out of a building, like, for example, if you tip it upside down, furniture, loose fittings, things like that would be able to depreciate. But fixed assets such as gyprock and flooring, brickwork, all of that could also be depreciable under a different class and under different rates of depreciation.
So obviously there's other assets that can also be depreciated, and there's different ways of doing the depreciation. I've got my depreciation report in front of me, and there's always two columns. One I believe is called diminishing value, and the other one is called prime cost.
That's right. And so
what's the difference?
Essentially, the prime cost is meaning that you apply a fixed rate to the depreciation of the asset. So you can apply a prime cost method of depreciation to the building. That's the only way that the ATO allows you to claim, which is Division 43, which is your anything that is part of the building. So your floor slab, your ceiling, your brickwork, your gyprock, all of that is classified as building works, right? When claimed at 2.5% in a residential property. Okay. If it's used for heavy industrial, all that brickwork or anything you install there that's part of capital works or building materials can be claimable at 4%. So if it's
commercial is more.
Not commercial, has to be heavy industrial,
industry,
or motels, hotels, guest houses. They're considered high usage, so they have a more aggressive rate of depreciation. But that's a 4% rate for high use, which is fixed, which means you get 25 years of depreciation. But most, all residential and also light commercial, such as an office or a warehouse, that is depreciable at a 2.5% rate.
So 40 years.
For 40 years. And so there's a little common sense to it all, the way that the ATOs allowed it. Not to everyone's liking, because some people say, oh, you know what, my premises wears and tears much faster than, there's a blanket rule on it. And unless you can get a private ruling from the ATO, which is a case of making a submission and requesting for something special, a special condition for you in case that your usage doesn't fall in there and you want special conditions, that is something you can always negotiate with the ATO. But for generally all asset classes, residential, light commercial, and then you have heavy use commercial. So that's where you have your fixed rate of depreciation. When it comes to diminishing value, now this is a case of wanting, the ATO sees it that investors want to really depreciate their assets at a much faster rate. So they're getting more claim back in the earlier years. And it's just an option for people. They can still use the prime costs for plant and equipment. So for example, if you had an oven, you'd like to depreciate it. It's got a 5-year effective life, for example. You want to depreciate at a slower rate, it's there. That's called the prime cost method. So it's essentially you're getting the same amount of depreciation over a 5-year period at the same rate, but then they introduced the diminishing value method, which means that I want to, yes, it's got a 5-year effective life, but what the ATO does is create a formula where they actually allow you to increase the depreciation rate in the earlier years. So you're getting more of that cash back in the earlier years.
Yeah.
And then part of the diminishing value also encapsulates what they call is low value pooling. Right. So what you'll see on the back of your depreciation schedule B is that we've got assets such as furniture, we've got carpet, we've got lighting, we've got lots of different pieces of plant equipment, anything that's motorized. You can think of hot water systems, air conditioning, ceiling fans. Now, the low value pooling method is saying that anything that's worth less than $1,000 B, you could actually aggressively depreciate it rather than saying, okay, the asset's going to last 5 years. Let's depreciate at a 5-year rate, even under the diminishing value. Once it's valued at $1,000 or less, they give you a depreciation rate that's more aggressive. Okay. And then once an asset, or even when an asset is depreciating at, say, for example, it's worth $2,500, once it gets to $1,000 or less, it kicks in a new depreciation rate. So you can aggressively depreciate that. Otherwise, what happens is you end up claiming $100 a year, especially on an older, a longer lasting asset such as carpet. And the ATO is like, well, where's the common sense in allowing the investor to claim $5 or $10 a year when they can just aggressively claim it for the next 5 or 6 years and it's gone, fully depreciated. Then there's also part of the low value pooling. They have the instant asset write-off. So once an asset is worth less than $300, you could, its purchase, its acquisition value is less than $300, you can write it off 100% in that year. One thing you got to be careful of with low value pooling and also the immediate asset write-off is if you have a set of dining chairs. The ATO is a little bit specific on this. If you have a set of dining chairs
per chair, it's per set.
That's right. It's a set of chairs, right? So they have to be grouped together, and a $300 chair times 6 of those, you've got to depreciate at the $1,800 rate.
But like if you had a ceiling fan, that's per fan.
Correct. That's right, because it's dedicated to specific to per room. So that's something that people can be cheeky about, but the ATO does have some rulings very, very specific to ensuring people don't try to, bypass the tax laws, on that.
So looking at the schedule, I think as you said, the diminishing value is a lot faster at the start, and it tapers off
more aggressively
later on.
Correct. So you get that good depreciation early.
So I guess in that sense, it depends on where you are in life. Are you just starting out as an investor and you're on a lower tax rate? So you might not want to go too aggressive initially and use the prime cost initially, and later on when you actually start to be at the higher tax bracket, that kicks in.
Take more advantage of it at a higher tax bracket at a later stage, which is where you're delaying the gratification of prime cost depreciation. That's what we find with many investors. Some great cases that I've come across, not that I do tax returns, as quantity surveyors, we only do the depreciation schedule, which is the assessment in value of assets.
And then you're a valuer, essentially.
Exactly, for construction purposes. And so what we find is people on maternity leave, for example, they're also a really good case of where people are not claiming depreciation. They don't have the income to claim depreciation, or they're on very minimal income. So that might work out well for them. So why would you go on the diminishing value method and lose all that aggressive depreciation when you could defer the depreciation or delay the depreciation using prime costs?
All right. So we talked about the two different ways. Now, obviously, the overall value is the same for both pools. It's just the rate you do it and the schedule of it is different. Maybe we sort of briefly go into how we actually calculate that value. You basically sum up every single item and put a value to it. And I guess let's just use some real numbers, okay? So if we say we bought a house, it's $1 million and the land was worth 400, and so technically the building is worth 600. But that's not always the case, because there's costing and all sorts of different things. So what is worth may not be the actual cost.
That's right.
So what do you do there?
So I guess walking through that and just going on that point while we're on the topic of diminishing and prime costs as well, just for the audience, is that once you choose a method of depreciation, it's important that we stick to that method of depreciation. Otherwise, what we have is, because both methods of depreciation will give you the same total of depreciation. So not one gives you a better advantage than another. So you have to stick to one method, and that stays throughout the life of that property, so as to not double dip essentially in depreciation. Going to your next point is about how do we construct a tax depreciation schedule. And the tax depreciation schedule is essentially the assessment of the building value, no matter what the purchase price is. So we have to be very level-headed about when we go into a property. It doesn't matter what the property, how much we pay for it, where the property is. It's all about the finishes and the detail that goes into the finishes, as well as the goods themselves. And if, of course, you're comparing brick veneer versus a double brick home, a suspended slab home versus a soft floor or timber joist a second floor.
Getting very fancy now.
we have to be very specific with this to ensure that. When we're looking at properties, no matter where it is that what type of investment has gone into the construction and development of that building. So that means that assessing the type of construction on that property will dictate how much depreciation can be had from a structural perspective, because of course more concrete used, double brick homes, they're going to be more inclined to have a higher depreciation on the prime cost side. So that 2.5% building value that you're getting per year, that's going to be a lot higher than your typical home that's brick veneer and upper floor is made up of timber flooring. And so they're the type of things we're looking at. So when you go into these properties, that's the first thing you look at. You look at what type of construction to decide, okay, here's a property purchased for $1 million. But yes, it's purchased for $1 million, but it's built, for example, in the inner west of Sydney. Well, that's going to have a very high land value, right? And so the construction cost typically will be very little. So we're looking at something, for example, if we go in there, and let's go to maybe a simpler example. If you go into the outskirts of Sydney, you're going to find places for $1 million, but that's going to be $400,000 worth of land, and the rest of the balance is going to be $600,000 worth of construction costs. So immediately the first thing we do is we say, okay, here's a property that's 200 square meters, right? And the 200 square meters, and we're looking at a building footprint of, for example, call it $4,000 in $4,000 a square meter is what we would be allowing per square meter for this property. So we're looking at that's going to be $200. That's going to be $800,000 in building costs. Now that might then blow out your land to $1 million. Is going to be $200,000 worth of land, which is quite uncommon in Sydney, but we're going to work on the rate. So the rate will determine the construction cost, and it has nothing to do with the land, right? And so it's up to us to make sure that we value the land, the building appropriately, to ensure that they're not overcapitalizing on the depreciation. Because end of the day, if the quantity surveyor does overcapitalize on the depreciation, on the construction cost, it's then a case of then going to the ATO and submitting what is. This quantity surveyor said that we're going to get $25,000 in construction depreciation this year. Well, how did I come up with that? The ATO, then we would have to substantiate that through the depreciation schedule. And in that $4,000 a square meter of construction, we would have to build up in there flooring, plant equipment such as your hot water systems, your ovens, your range hood, your cooktops. If there's an integrated fridge, which is unlikely. Of course, if there's heated flooring systems, that would all fall part of the plant equipment in that property, if that makes sense. And so the balance of that, usually when we come up with it, the $4,000 a square meter, we would work out, for example, that $800,000, we would work out all your plant equipment. And for example, if the plant equipment equates to, say, $150,000 in that property, well, the balance of that would be $650,000 of building materials, which is your 2.5% rate. So 650,000 times by your 2.5% rate would give you that fixed prime cost per year that they can claim. So it's very clear we have to distinguish the prime cost at 2.5%, and then the plant equipment has to be separated, because each line item, for example, oven might depreciate over 7 years, range hood 5 years, carpet 12 years, hot water system. And so when you have each rate of depreciation, will give you those line items for how much depreciation in the first year. And then you have to take into consideration things that are valued less than $300. For example, you might have a towel rack that might be worth only $200.
Yeah.
So you would write that off at 100% rate
nice
that year.
back.
So then you break down each of these per annum, and then you would then say, okay, based on the first year depreciation on the plant equipment side, we're going to be claiming $20,000 in the first year of that $150,000.
Yeah. So the equipment plan sits in its own little column, and then there's a prime cost for the
correct. So the $650,000, you would take that as its 2.5%.
Yeah.
You would claim that in a separate column, and the job is then to add the plant equipment with the building cost to give us a total depreciation for each respective year, and that will vary. What you'll find in the diminishing value method anyway, very high plant equipment value, and then the same building value each year. You combine that to give you your total depreciation for that year.
Okay. So it's really the plant and equipment, correct me if I'm wrong, that you either do it through the accelerated schedule or you do it through the prime cost method to depreciate over 40 years.
That's right. And it's only the prime cost method we use for building. As required by ATO. Regardless of the building type.
Yeah. So that explains why those two things are different, but not that different, because when you look at diminishing value for, say, a laptop, for instance, I mean, for instance, it's 3 years. It's like 25% each year.
Correct.
And so that is much more accelerated, but you only see the acceleration on the plant and equipment part and not the actual building itself.
That's right. Yeah. And that's why you get, for that you get, and of
when
course
it tapers
for a laptop,
off later on,
it'd be a very unique curve, because the 2,500 would reach, especially over 3 years, you would reach $1,000 very quickly, and you get aggressive depreciation again because of the low value pooling.
Yeah, so it goes doom and then doom.
Yeah, that's right.
Yeah, very nice. Which we briefly touched on is like, how do you maximize the usage of the depreciation report? Because you said if you expect yourself to be going on mat leave a number of times, or you're earning less money right now, it may be better to use the prime cost method rather than the diminishing value method to save a bit more later on, because it's obviously taxed at a marginal tax rate. The next part of it is that if you decide to use a depreciation schedule, can you at any stage decide not to depreciate anymore? For instance, because 1 year you're not earning as much, because when you do depreciate anything, it comes off your base costs when you do sell a property, right?
Correct. Yeah, there are some.
The flip side. We want to talk about the flip side.
There is some balancing adjustments that people need to be aware of. I'm not an accountant to give advice around that, but what I can do is give some information in that I've had some experiences myself. So when you do go and claim depreciation, that of course, if you bought $1 million property and you've been claiming depreciation for 5 years, and in that 5 years you've claimed $100,000. Well, that $1 million property you've bought is actually now worth $900,000 because you've claimed depreciation of $100,000.
Yeah.
Now, knowing that, so when you go to sell that property for $1 million, you're now making a $100,000 gain.
Yeah. So your cost basis is lower.
Reduced. Yeah. So just a point on that is that the $100,000 is only on your capital works, which is your building depreciation. Any of the plant and equipment that you claim does not reduce that cost
So it's
base.
only the prime cost part.
It's only in the prime cost of the building works that comes off that. The plant and equipment needs to have a balancing adjustment. Now, this is the bit that's a little bit gray from my understanding, but I'm not sure how that's added back on. But that's something that they'll need to speak to the accountant about. But that's something that you really want to make sure is that you don't completely take off the complete depreciation as a reduction in your cost base, because that could bite you badly, especially when it comes time to sell. So making sure you seek advice of a good accountant that understands how the balancing adjustment works for the plant equipment side, so that way you're not left out of pocket even more after the tax bill arrives.
Hi, I'm just going to interrupt this episode for a brief moment. If you've been enjoying this episode and just realized that you could be saving up to thousands of dollars with a depreciation report or a valuation report, we've got a deal for you. We've managed to secure a $100 discount on both of the services that DualTax runs. And if you would like to take advantage of this special deal, you can access this deal via the link below in the show notes, or visit ifdgroup.com.au/DualTax. That's DUOTAX. And now back to the show. So also the other thing is that for some of the viewers out there, they, for instance, might have purchased the initial property that they lived in, and then they upsize and then they get out, like say after 5 years. When you get the depreciation report after you've moved out, because you've now made your own occupied investment property, how does that impact depreciation?
Yeah, so the 2017 legislation that was trying to address the concerns that people were essentially double dipping on depreciation. That was now, it's been 8 years now since that legislation came out. But essentially, if you buy a secondhand property in today's market, post 2017, 9th of May 2017, post that date, if you exchange on a property and that property is secondhand in nature, meaning that you did not build it, you did not buy it from a developer, brand new, you are not entitled to claim depreciation on the plant and equipment. So that 150K we're talking about, all of that would be abolished, would not be calculated as part of your depreciation schedule. If you go and build something yourself, you're entitled to claim full depreciation, subject to that you use it with the intent to earn income, meaning that it's a rental property or investment. So from day dot, it has to be that intention. As soon as the intention is to live in it or use it as a holiday house frequently, then that would be deemed as secondhand because you've used those assets for personal use, and no longer will you be entitled to claim depreciation on the plant and equipment on that property, even if you installed a brand new. However, of course, when I said frequent use, infrequent holiday usage still protects the property from being used.
But in a general sense, then plant and equipment is off.
Correct. Yep, that's right. So anyone who's buying a secondhand property would not be eligible, as well as anyone who's building a brand new property and using it in a personal way before they rent it out, they would also be non-eligible. So renting it out, living in it, and then renting it out again, that initial part, you can claim depreciation if it's brand new, but it's the point where you use it for personal use and then rent it out again, that's where it's deemed as secondhand in nature.
So that's on the plant and equipment side.
Sure.
So if we, in my case, we bought a place, on my third year out from medical school, and we lived in it for 3 years before we upsized and moved somewhere else. So that property we have a depreciation report for, and I think we got it basically when we moved out and made it investment.
What year
property.
was that? Be?
That was in 13, I think.
So pre-2017.
So pre that, so we got to claim all of those things. But the depreciation report starts from the day we got it, obviously.
That's right.
But we've obviously also lived in it for a number of years, and which we can't claim anything for.
Yes. And then so for 2013, if B was owner occupying this property from 2013 and he lived in it for 3 years before he moved into another property in which now he rents out his first property in 2013, he purchased it. Because that was before the legislation change in May 2017, which is 2016, you moved out of it, you're still entitled to claim depreciation at the old method. So the rule grandfathers anybody or protects anybody who purchased a property before that 9th of May 2017
So if I say
date.
then let's flip the situation a bit, and if I moved out in 2018, do I still get that because it's settled in 2013?
Because it happened in 2018, you're not grandfathered.
Right. Okay.
So it's only protecting people who are renting it out before that
with
date.
the intention
So even if you bought a property before that date and today you decide to rent it out, you are now under the new rules.
I see. And now we're going to go into the next sort of complication. So because now I've got that property as an investment property, I can only depreciate it from the point I moved out.
Correct.
Right? But the 3 years I've lived in it because it was for my own usage, I can't depreciate any of those values. So from the 40-year prime cost perspective, I've only got 37 years.
Correct. It's prorated based on the date of completion or the date of settlement or the date of renovation completed if it's a renovated property, and you get the balance of that. So if it's 3 years owner occupied, then you get the balance of 37 years to claim depreciation at the prime cost rate.
Now another scenario. I bought a place that I'm going to move into, but I haven't moved into it yet. It's an investment property. I've now left it for say 5 years before I moved into it. I can obviously depreciate the first 5 years.
If its intention is to be an investment
But
property.
it was from the get-go.
Yep. They have specific rules in that I believe there is some legislation around vacant properties.
No, it wasn't vacant. It was rented out. People lived in it.
Yep.
We made income from it, and legitimate.
So for 5 years, it was an investment, rented it out, brand new, can claim full depreciation for the 5 years. What happens at the 5th year?
Oh, so now we moved in. We can't we can't depreciate anymore.
That's right. And if you decide to move out of it, you still can claim depreciation, but albeit only on the capital works, which is the building depreciation, which is your 2.5% that you're claiming every year.
So even if I started before the 2017 rules,
you lose the plant equipment.
But hopefully by then it's already
you would have been able to
I would have done the diminishing value way aggressively, and then I moved into it. I can't depreciate, and then now and just for reference point, you get the bulk of the depreciation on diminishing value on plant equipment happens in the first 5 to 10 years. And whereas prime cost, the bulk of the depreciation is happening in the first 15 years. If you're doing that strategy, diminishing value is going to work a lot better for you as a cash flow tool. So it's really about getting the tips on which way to depreciate based on your forward planning.
And I just use, now that I mentioned the cash flow tool, is because of the balancing adjustments and the reduction in cost base when you're claiming depreciation, people have to see it as that, right, B? Like the way you're talking about it is you're claiming good depreciation in the first 5 years in a property that you rented out for 5 years first before you lived in it. Well, what it does is it enables you to, build up that cash flow and essentially allow you to pull that saving, put it into another asset, invest in another property, go on holidays. That's what it really is doing for everybody. So that's what the way that we've got to be seeing. It's not free money, because when you go to sell, there are, I believe, some, of course, disadvantages. But on that note, I believe when I sold my property, I was entitled to a 50% CGT discount because I buy my property at my personal level. And that means that I get a discount on my taxes when I go sell the property. And because you're claiming 100% tax deduction when you get the deduction for depreciation, but you're only paying back half of it if you're buying in your personal capacity, I was able to, even on the at the end
of it,
I'm up. So there are advantages. Yes, there are some disadvantages, but the upside outweighs the downside. And so if you look at it as a cash flow tool, the upside is you're getting the money upfront and you're doing whatever you want with that cash flow before you even think about selling it 5 years or 10 years down the track. So that's the beauty of what tax depreciation does for any property investor, including interest on a loan, right? It's a tax deduction. What do you do with it
helps with cash flow.
It helps with cash flow at that point.
Beautiful. Now we've got another particular scenario. Say we had a property, we did some significant renovation onto it. And let's just say it's fixing up the kitchen, which is new plant and equipment. Can you depreciate that? Like you get a new set of depreciation for that, regardless of when it was done?
And if you've got an existing depreciation schedule, it's always good to make sure that, for example, if you've got a kitchen and you've got depreciation schedule on the old kitchen, and they say, for example, put all the plant and equipment combined, for example, oven, range hood, cooktop, fridge if you have, under sink, boiler, whatever you might have in equipment. And if all those assets have depreciated, but they haven't fully depreciated, and there's a balance of, say, $2,000 in all those assets. Now, it's good to check the depreciation schedule. What is in balance in 2025? We can then write off all those assets because they've been scrapped from the property. So you get a $2,000 immediate deduction, and then you go and reinstate a new kitchen, right, through the renovation. And now you've got a brand new kitchen that's cost you 40 grand, right? But the depreciation on 40 grand isn't just 2.5% of 40 grand. You're going to work out all the effective
individual
lives
items.
of those assets, which is faster than the building. So your new underwater bench, boiler, whatever it might be that you have, you get the depreciation on that, and then eventually you're going to get some good depreciation, but also that good instant asset write-off, which is all the things that you scrap. So we call it a scrapping report because even that kitchen, if that kitchen was renovations can only be depreciable if it's completed after the 27th of February 1992. So if that kitchen is built after 92, that means that you can, that was renovated after 92, you could claim any scrap value in that. So if you've got a place that you bought and it's got a year 2000 kitchen in there from brand new or renovated, if you scrap that kitchen 22 to 25, 19, year 2000 to 25, that's just a bit under half left of the depreciation. So if it's got a $10,000 kitchen,
that off.
you could probably claim $4,500 as another tax deduction right off.
Wow.
So you got $4,500 on the kitchen, $2,000 on the plant equipment. That's $6,500.
Yeah.
You could potentially claim as a write-off because of just pulling that kitchen out. So before you scrap anything, make sure you take photos and you ask a quantity surveyor, can I claim any scrap value out of this property? That's an investment. And I'm going to then claim a depreciation schedule for the new kitchen, bathroom that I reinstate in this property.
Jesus, that's a pro tip.
It's a good tip. And you know what? Where it's most valuable?
Yeah.
Commercial. Because commercial properties, the frequency in which you gut commercial properties, right, is quite extensive. And when you do a gut of commercial property, you don't do just partial. You go into a new office, you scrap everything. And offices are rarely ever 40, 50 years old, right? Given the frequency in which businesses turn over. So going into a property and just using ours as an example, in our fit out that we did 5 years ago, we scrapped that. That was a building that was only built in 2005, I believe. So we had moved in there in 2000. So 15 years old, we had still 25 years of scrap, to depreciate. Scrapping that property, I think the fit out was valued at 150 grand. So it was 150 grand worth of fit out we scrapped. Then we reinstated another $300,000 fit out. So we can claim 2.5% plus the plant and equipment on the new fit out and the $150,000 write-off. Imagine that as a tax deduction for any business owner.
Yeah,
I think it's
that's amazing.
Huge.
Yeah.
And anyone who's owning a medical practice. I mean, I've done plenty of those in which we help people scrap, get a value assessment just on the existing fit out, scrap it. And very importantly is the fit out has to be owned by the person owning the property, purchasing the property.
Yes.
So if you're buying a property as an investment and there's a current tenant in there and that tenant had purchased that fit out, then you are not entitled to that. But if that tenant decides to vacate that property,
that's yours.
You own the fit out. And so when you scrap the fit out, you either claim the depreciation on the fit out, but if you scrap the fit out, you claim the balance of that fit out scrap.
Okay. So what if you get a new tenant and then they want to scrap it? Can you still get the
because essentially what's happening is
because it's now yours, right?
Yeah, that's right. Because you purchased the property with the intent of owning that fit out. So when they leave it and the fit out's there, that's under yours.
That's now yours.
In your control.
Yeah. And so if a new tenant comes in and says, I want to scrap everything, and they've scrapped it, you can claim it.
You can claim it because you own that scrap.
Oh my goodness, that is insane value.
It's a lot of value. That's why I say the commercial setting is very much the case because it can be quite expansive and fit outs, as you know, are not cheap, but they do have a lot more intrinsic value compared to a bathroom or kitchen renovation you do in your house.
Wow, I think that's probably content for another time, and we need to discuss that further because my mind's been blown by all of this. And so I guess the take-home message is speak to a quantity surveyor when you first get any sort of investment asset, and then if you're going to make any significant changes to it, do that as well.
That's right.
And any other situations where it's advisable. Speaking
about mind-blowing. One thing that one of the accountants that we work with, he asked me many years ago, he said to me, Tuan, you're a quantity surveyor, right? Your job is to assess for construction costs and you do it for depreciation purposes. I've got a client that has purchased a property many years ago. He then went on to put a building on that property. Then he's transferred that property to his daughter. And that daughter now has some CGT liabilities on it because she's decided to sell it. Now, the question is, the father had built this property, but doesn't know the value of the construction. He did it by himself, no paperwork, no documentation from 20 years ago. But the property has astronomically grown, right? And we're talking about millions.
Yeah.
And say, for example, it's a $2 million capital gain on this property. He goes, Tuan, this customer would have spent at least $800,000, he believes, because he's got no record or documentation. Can you go and do an assessment, a thorough assessment to assess how much construction cost actually went into that at that point in time? So as quantity surveyors, when we work out building costs, it's always in respect to the time it was built. So there's an index that the AIQS, which is Australian Institute of Quantity Surveyors, they give us an index. For example, if it costs you $3,000 per square meter today, they give you an index of say 0.5 to build something back in year 2000.
So is it always based on the
Square meter rate?
Square meter rate?
As a very simple method. It's a very simple method of calculating. Rawlinson's, which is essentially the go-to guide when it comes to all things construction related, gives you an indication of what things cost to build. For example, a 3-bedroom home in Sydney that's brick veneer versus a 3-bedroom home that's built in Brisbane. So they have comparisons to these based on market rates and whatnot's happening in different cities. As you can appreciate, different cities have different rates, and metro versus rural, et cetera, and they also capture travel costs, material costs, logistics and whatnot. And so we always use that as a guide. That's why I use the $4,000 square meter or three. These are guides that the Rawlinsons, for people that are reading out there, if you're wanting to know where the guide is for certain things, you apply that square meter rate with the building footprint. That gives you an idea around what that costs. Not always perfect, especially when you go into high-end construction and you've got marble and granite. It does throw out that, but for very basic, it is a great guide. And so if you've got a property that's, going back to my example, is this father who had built this property doesn't have record, well, in the ATO's eyes, that's a $2 million capital gain, right? But they haven't taken into consideration any construction costs.
If original capital.
As a quantity surveyor, once we assess that for the value it was back in year 2000, it was based on $800,000 that we come up with. It reduced his capital gain by $800,000. So we were able to, his capital gains tax bill was only reduced to 1.2 mil. And so that's a big, impact. Just having a quantity surveyor do an assessment, especially in cases where you aren't able to justify the cost in materials and labor to prepare or build that property, especially when it's owner occupied. Owner builder, sorry. Once owner builder, most of the times they don't have record of this, and for them to warrant that is something that's very tricky. And so getting an independent person like a quantity surveyor that's arm's length to assess the property for a small fee, it saves them thousands or hundreds of thousands of dollars in tax. So it's something that, if you ask me scenarios, it's one thing we do not often, but often enough to make I know how much of an impact it makes property investors or any client that has these types of situations.
Yeah, beautiful. That's a really useful tip. All right, now before we finish, any sort of take-home messages for our viewers? Well, some things that you need to know. Depreciation, of course, as I mentioned, is a cash flow tool. If you haven't heard about depreciation, right, lots of people who are going to watch, they haven't been into property before, or going out to the property for the first time or second time. If you haven't heard about depreciation, it's quite new to you. You can go back and amend your tax returns. You can go back and amend up to 2 tax returns without asking any questions with the ATO, which means that there's thousands of dollars on the table, even for an old property. So if your property is 10 years old or from 20 years ago, and there's still 20 years listening to this, and the cutoff for capital works or building depreciation is 1987. So if your property is built in 1987 or after, there's a good chance you're going to be entitled to 40 years of depreciation, so 2027. So you could still claim 2 years of depreciation if your property is built in 1987 today, meaning that you could go back and amend 2 tax returns and claim all those dollars, right, from previous years. But if you've held the property for maybe say 5 or 10 years, right, 5 or 10 years, well, you know what? You can go back and raise an objection to. There's a form called an objection form from the tax office. You can fill that in, just say, I've never been given the right advice. Can you please allow me to claim the last 7 years of tax deductions because of the depreciation I've missed? That's up to the ATO. It's at the discretion of the tax office, but for sure, you're entitled to 2 of them. So that's some great information, I think, for any property investor, even new and old, to go out there and claim. And if you haven't claimed, when's a good time to get a depreciation schedule? Probably a lot of people ask me. The best time is when the property is vacant. If you recently purchased a property, get in there before the tenants are in there. Or if you have a property already, get the report done before 30 June, because once you tick over to the 1st of July, that invoice that you pay for the quantity surveying services, you don't claim until the following year. So that's always my advice when it comes to claiming depreciation. And I guess a lot of people are asking, how do I know when my property is built?
How do I know how old my property is? How do I even know if the property's been renovated? Because I couldn't tell. A property built in 1980 and the renovation happened in 1995. Like, is it? Well, it's a matter of asking the question. And then end of the day, when a quantity surveyor, when you pick up the phone, ask a quantity surveyor such as ourselves at Duotax, we always check for the client. We do all the due diligence before the customer is expected to pay any money. And that gives them comfort and peace of mind to know that, hey, this property has been renovated. We make that assessment. This property's been renovated in 1998. You're entitled to $3,500 worth of tax deductions in the first 5 years. Would you like to proceed? The customer then is, given enough information to make an assessment, go to their accountant, ask the question, or go to seek a professional advice. Is this worth it? And I guess that's a really good way, because in this day and age, with the technology we have with RP Data, CoreLogic, and all these great softwares, we're able to make that assessment on the spot. And it's, end of the day, being registered tax agents, that's what quantity surveyors have to be in order to provide tax depreciation services, is that it's in your professional opinion to decide whether something's been modified or renovated or not. And it's up to our professional judgment to make that call. And so I guess that's the brilliant thing, is that we can make that call on the spot.
Beautiful.
And gives the investors peace of mind.
Yeah, awesome. That's really good advice. And I think anyone who's investing in property should explore this, definitely.
For sure. Yeah. It's money on the table.
Yeah.
And it's a tax officer's money.
Beautiful. Thank you so much for coming today.
Thanks, mate.
We'll like to have you on the show in the future.
Awesome. Thank you, Ben.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.